Investors, welcome back to another episode of the Investor Mindset Podcast. I'm your host, Stephen Pesavento, and each week we share mindset tips and real estate investing strategies that help you take your business to the next level. And today is no different. We're going to be diving into a topic that I think is going to make a huge impact on your knowledge of investing in real estate, and there's an opportunity that's going to come along with it. So you want to stay tuned and get ready to dive in.
This is the Investor Mindset Podcast.
So today we're going to be talking about the importance of value-add investing when you're reducing expenses as the way to add value. So for all of you who are new and for all of you who've been in the game a long time, you understand that value is added when you increase income or decrease expenses. Where that ends up trailing to is it increases the overall net operating income of the business, of the asset in this case, of the multifamily property. And that ends up directly leading to a value growth that happens from the property. As a reminder, multifamily properties are valued based on a denomination of income, net operating income, and they use what's called cap rate. So cap rate is a percentage, and you divide the net operating income divided by cap rate to understand what the value is. So in this example, because there's two different ways to add value, it's either through increasing income or decreasing expenses. In this example, we're going to be doing both. So majority of the deals that we do and we do with most of our partners, income is our primary focus. It's our primary driver. We're looking for opportunities where rents are lower than what the market is, and we have an opportunity to come in, renovate, increase rents, or just directly purchase and increase rents, and that's going to end up driving up NOI, and that's going to end up driving up the value of the property. Well, there's another way to do it, and it's actually much more conservative to decrease expenses. When you can effectively decrease expenses on a property, you can do so while spending less money in the short run, while also taking less operational risk regarding people being willing to pay those higher rental premiums. So there's a little bit of risk that comes in with what you project rent can be for your specific asset. One of the ways we reduce that is we look to buy assets that are similar to other comparables in the area, or we look to be able to raise rents based on existing examples that have already happened within that particular property. But in this case, I'm very excited because our newest opportunity is located in Dallas, Texas. And what's cool about this property is that it's one that is 100% of expenses on the property are paid by the owner. That means it's an all bills paid property. You may have seen this when you were in college, or may have friends or family who've lived in a property like this. But essentially, the manager has the responsibility of paying all of the expenses for the air conditioning, for the heating, for the electricity, for the water, for the trash across the entire property. Now, one of the reasons this happens is because it's a single master metered property, meaning there isn't individual meters for each unit. So how do we get around this? Well, there's something that you can do where you can actually implement a system to understand what is the power that's going to each individual building, and then you can bill back a percentage. Now, common in this part of the area, being very conservative, we're able to bill back about 70%, 70 to 80%. Realistically, we have the ability to bill back 100%, potentially more, because of a special value add that we're going to be adding on top of it. I'll tell you in a second. But what's cool about this strategy is when you go in and you're able to reduce expenses on a property, what you're doing is you're directly increasing the income, but you haven't taken the risk of projecting out your ability to increase the income. Now, in this case, what's wonderful about it is that we're actually going to reduce the expenses. You know, this property expenses are about $372,000 a year. We're going to reduce the cost of that expense with something I'm going to tell you about in a second. And then we're actually going to bill back 80% of that, 70 to 80% to tenants. So we both reduce expenses while creating income. So simultaneously, we move the flow of that net operating income up dramatically. Just by removing the expenses is a big bump, but by also billing it back to tenants, is a key strategy that ends up allowing us to dramatically increase value and therefore increase investor returns, and do so very quickly, and also have a lot of control over how we end up dictating that out to tenants. So what's important to understand about this is that when you're going to do this, you want to look at what are other comparable properties doing in the area. Are all comparable properties all bills paid? In our case, they're not. All of these properties have already implemented this same strategy. It's common in our area, and all of our comparables are lining up exactly with us. So we're behind the ball. Great opportunity to add value as a result. The other cool thing that we're going to do to reduce expenses is we're going to implement a water reduction savings program, which essentially you install some different valves on the property and it dramatically reduces the water bill. So that's a huge savings. But on top of that, we're actually going to be installing income producing solar. So I'm going to have a whole episode talking about the power of income producing solar. But as a result of installing the system, which is going to cost about $1.7 million to install this system, it has a long life, 20 plus years, and we're planning on holding the property for 10, refinancing and returning all investors' capital within 3. But what's cool about this is we'll reduce those expenses by about $72,000, potentially higher per year just on electricity. So by doing that, that adds about at a 5 cap, a 4.5 to 5 cap, that adds about $1.7 million of value to the property. We install this system. There's a lot of great incentives and tax benefits that go along with it. So we'll actually reduce that cost significantly. I'll be able to share a little bit more about that in that episode that I'm going to talk through those details. But this is a great thing to look for when you're looking for conservative investments that create great returns, is where can you reduce expenses? A lot of folks are focused on increasing income. It's a great strategy. It's something we definitely do. But when you can find properties that are mismanaged or have not taken advantage of bill back programs like this, then it can put you in a really, really strong position. So if you're interested in getting involved in this particular deal or deals just like this, I encourage you to go over to vonfinch.com/offer. That's vonfinch.com/offer. You can find more about this particular property. We're going to be implementing a income producing solar as well as billing back to tenants while increasing the overall experience for tenants on the property. I think you're going to like it a lot. That's vonfinch.com/offer. And I look forward to being able to serve you guys. If you have questions about this, definitely leave them down below in the comments. Shoot me a DM over on your favorite social media at Steven.Pesavento. Me or a member of our team is going to be getting on those, answering those questions. And we're excited because we've been closing a lot of deals lately, and we couldn't do it without great partners like you. So thanks for joining us, and I look forward to seeing you on the next episode.
Thank you for listening to the Investor Mindset Podcast. If you like what you heard, make sure to rate, review, subscribe, and share it with a friend. Head over to theinvestormindset.com to join the Insider Club, where we share tools and strategies from the top investors and entrepreneurs on how to take it to the next level.